Vinod Karki is now joining in from ICICI Securities to give us a glimpse of his view on the markets as well as the earnings outlook. And Vinod, we've gotten quite a bit of support coming in from the FII community, but largely this rally is led by what's going on across the globe as well. Do you think that it's looking sustainable at the current levels? Is that mood of optimism currently there in the markets?
Hi, good morning. So that's a correct point you just talked about. If you see what's driving this market, it started with if you see the global central banks, they have been quite active over the last several months, primarily because they want to ensure that their economies don't slip into a slow growth phase or a recession. Now, if you juxtapose what's happening in this year, 2019, versus what happened in 2018, it is exactly the opposite. 2018 was a year where we had the phase of a quantitative tightening. The US Fed's balance sheet reduction program started, they were raising rates, and the whole QE that we saw after the global financial crisis started reversing in year 2018. Now that actually roiled the emerging market picture quite a lot. So in 2019, first signs of the liquidity, or you can say QE, milder version of QE, started happening in August itself actually, when the US Fed for the first time after 5 years started buying treasuries, and the ECB also signaled that it would start buying it would start its QE part 2, although a milder version, starting from this month, November. Mind you, they have not even started yet. But the US Fed, if you see, their bond buying program accelerated from August till October to 60 billion now. In August, they started with a small 14 billion. And they have been cutting rates, right? So globally, if you see US, the ECB, the PBOC, India, the RBI, so globally it is a concerted effort by most central banks and the government to ensure that the global growth doesn't slip into a slowdown or a recession kind of an environment. So that's a complete stark difference from 2018. So which actually improves the outlook for emerging market risk assets, So we started seeing this effect, and we had started becoming constructive on our market over the last 2 months. Other reason being that 2019, if you see, should be seen as an outlier year, because a lot of transient factors which is showing up in the slow GDP were affecting the economy. So what I mean by that is, if you look at this government's record since they came to power in 2014, they have been, focusing on development expenditure more than social spending. But because if you see at the start of the year, the elections were around, and the focus suddenly shifted more towards these kind of spending, which were more populist, if you may say. But once the elections are over, we are again seeing the focus shift back to development expenditure. If you see the capital expenditure of the central government for the month July, August, September, it is up 65% YOY. So again, that you have to see in the light of transient factors, the slowdown that we are seeing. Also weather disruptions. If you see, the extended monsoon affected coal mining, it affected the construction sector, it affected the cement sector. If you see the latest results, so that also cannot be extrapolated. A lot of transient factors, and there were a lot of liquidity issues at the start of the year, which we started seeing getting eased out. So the liquidity in the banking system is at a surplus 2 trillion plus right through July, August onwards. So a lot of these factors have started turning around. The cost of borrowing for the NBFCs have started coming down. So all these, it shows that the economy is not going to go down further, but we'll see a gradual recovery. So that is actually resulting in the expectation change over the last few months, resulting in the market kind of being surprised a bit. And even if you see the earnings right now, these Q2 earnings that we saw, for the first time after many years, I saw that the beats were more than the misses. and we did not see the Nifty earnings getting downgraded. But just to put a point, after these kind of significant reforms like tax cuts in the US, we saw that the earnings got upgraded for a period of almost a year after the tax cuts, So yet, even after these higher number of beats, we haven't seen analysts upgrading their numbers. They're just holding on to those assets. So we could see more beats going forward, given this behavior till now, which could sustain the markets. Nevertheless, the large caps are not cheaper by any means, but the expectation change is resulting in a robust market, along with what I called earlier about the emerging market situation improving as global liquidity and rate cuts are seen across the globe.
Sure. Okay, so that, of course, outlines, the overall strategy that you're looking at right now, Vinod. If you were to kind of just sum it up for us in terms of clear buys and sells at the moment, particularly given the kind of records that the index is trading at, what would be the top 5 things in your portfolio?
Yeah, so as I said, what we are seeing is that the domestic economy is seeing a normalization. So we will be more focused on the domestic economy facing stocks in our portfolio, where we expect the performance to be better. So obviously the banks, which are a large part of the Nifty as well as the economy, the whole financial services, and a lot of discretionary spending, I think, which got a setback due to this slower growth. Again, that should see a better performance. Even selectively, some staples like, let's say a Dabur, which showed resilience in terms of growth in a slowing economy. Those kind of stocks also we will be betting on. We will also be positive on the infrastructure-related stocks like, let's say, L&T and some of these other these domestic cyclical kind of where, for example, steel companies like Tata Steel, for example, we are seeing some improvement in the prices over there. So these are some of the pockets where we will be positive on as the economy comes back to a normal trajectory after slipping into a slowdown phase for a quarter or two.
So just tell us your top sectoral bets and stocks that you like.
Yeah, so as I said, we have in our top picks, we have Bandhan Bank, we have Jubilant Foodworks, we have even a few pharma companies like JB Chemicals, Torrent Pharma, right, L&T, and SBI Life in insurance. So these are some of our picks. Coal India, So these are some of our picks where, and we have listed them out in our report. And obviously, from a sectoral perspective, we are betting more on the domestic economy reviving and normalizing. So all the domestic-facing sectors and stocks we'll be more bullish on.
Right. Thanks for joining us then this morning, Vinod, and outlining your entire thought process right now.